Have you ever stumbled across an asset that looks, frankly, bulletproof on paper, but the only way you can actually get your hands on it is through a deeply flawed vehicle? Well, welcome to this explainer. Today, we're unpacking one of the most fascinating contradictions in the public markets. We're looking at the unparalleled quality of American farmland as an asset class and contrasting it sharply against its primary public gatekeeper. It's a story of incredible dirt, structural superpowers, and a very dramatic corporate reality check.
All right, I want you to think about this one. Incredibly resilient number for a second, 10 to 12%. Over the last 4 decades, the NCFRIF Farmland Index has delivered exactly that as its historical annualized return. But it's not just the size of the return that's staggering, it's how it got there. That 10 to 12% has been delivered with almost zero volatility. To put that into perspective, in 40 years of recorded data, American farmland hasn't registered a single year with a loss greater than 5%. In the investing world, finding that kind of stability coupled with double-digit returns, it's literally like finding a unicorn.
So you might be wondering, what exactly gives American dirt its superpower? Why is it such an exceptional wealth preservation tool? Well, it fundamentally comes down to structural supply and demand. The supply is highly inelastic. In fact, it's shrinking. Because of urbanization and degradation, the U.S. loses roughly 1 to 2 million acres of farmland every single year. You simply cannot print more high-quality dirt. On top of that, farmland acts as a massive, real inflation hedge. As food prices rise with inflation, land values and farm rents go right up with them. And perhaps most importantly for long-term holders, it shows a negative correlation during market stress. When equities completely plummet, farmland holds steady. Why? Because the global demand for food doesn't care about a stock market crash.
And the ultimate macro engine driving all that relentless demand? 9.7 billion. That's the projected global population by the year 2050. As the population swells, and especially as emerging markets increase their demand for animal proteins, the pressure to produce way more grain per single acre of land intensifies massively. The amount of agricultural land available per person is in a perpetual state of decline. So you have shrinking supply and aggressively expanding global demand. It is the absolute perfect setup.
Okay, so let's shift gears to our primary subject today and see how this all builds into our paradox. Enter Farmland Partners Inc., or FPI for short. For the retail investor sitting at home, you can't exactly go out and easily buy a fraction of a cornfield in Illinois. FPI solves that. They're the only large-scale, pure-play U.S. farmland real estate investment trust traded publicly. They are basically the liquid gateway to this incredibly scarce asset. But, as we're going to see, being the only game in town is simultaneously FPI's greatest institutional moat and its most glaring vulnerability. If you want the dirt, you have to go through them.
So what exactly are they managing out there? Well, they oversee roughly 157,000 acres spread across 17 different states. They basically deal with 2 distinct categories of agriculture: standard row crops and permanent crops. Operating across multiple states and distinct crop types is a huge benefit they offer over someone just trying to buy a single farm. It helps spread out those highly localized risks like, bad weather or a poor harvest striking one specific region. To really wrap our heads around how FPI balances their operation, let's compare these 2 different crop categories. On the row crop side, so your corn, soy, wheat, and cotton, these represent highly liquid land markets with annual or biannual leases. The prices here are driven heavily by global commodities. But on the permanent crop side, things like citrus, blueberries, and almonds, the whole dynamic shifts. These require much longer leases and offer higher value per acre, but they do come with lower real estate liquidity and higher tenant concentration risk. FPI uses the steady, commodity-driven row crops as their foundation, while using the permanent crops to chase slightly higher yields.
Now, how do they actually make money from all this land? The secret sauce is the triple net lease model. Here's how it works. Step 1, FPI leases the land to a qualified farmer. Step 2, that farmer assumes essentially all the operational headaches. If there's a huge pest infestation or operational taxes, the farmer absorbs that risk. And step 3, FPI just sits back and collects a fixed 2 to 4% rent on the land's value, basically risk-free. It's a brilliant way to capture the steady yield of the asset while letting the farmer deal with the locusts and droughts.
But here's a detail you absolutely shouldn't overlook. Beyond just the topsoil, FPI holds a true hidden asset that is arguably becoming just as critical, and that is water rights. Specifically, FPI has a significant portion of its land situated right over the Ogallala Aquifer. In a world facing crazy climate volatility, having secure access to underground irrigation water is a massive, long-term competitive advantage. Next to soil quality, it's the most critical factor out there, and FPI has it locked down.
Section 2. The 2023 Shock, Governance, and Short Sellers.
Let's get into it. So up until 2023, FPI was experiencing really steady growth, expanding its acreage and capitalizing on strong agricultural markets. But then August 2023 hits. A short seller named Saratoga Research launched a massive public attack on the company. The immediate fallout was absolutely brutal. FPI's stock plummeted by 30 to 40% in a matter of days as market confidence just completely evaporated. And even after the dust settled and an internal board investigation concluded, the company entered this post-crisis phase where a heavy governance discount was permanently baked into their stock price. To really understand what caused this massive panic, we have to look at the core of the short seller's claims. The attack centered on allegations of conflicts of interest and related party transactions involving founder Paul Pittman. Specifically, there were claims about FPI purchasing land from entities controlled by Pittman at allegedly favorable prices for the seller. Now, it's important to state impartially that FPI's internal board investigation did conclude without taking any formal action. However, in the public markets, perception is often reality. Once that narrative of conflicted interest was introduced, the trust was simply broken.
And the market's lack of trust was soon validated by a very tangible signal of financial stress. Before the attack, FPI was paying a dividend of 24 cents per share. Following the crisis, they slashed it right in half to just 12 cents per share. For a REIT, where investors are primarily showing up for stable, reliable yield, a 50% dividend cut is a massive red flag. It alienates their core investor base and signals a defensive posture to retain capital rather than projecting strength.
To make matters even more complicated, FPI isn't just fighting an internal battle right now. They're facing some serious external headwinds too. First, we're seeing a normalization of corn and soy prices following the spikes from the Ukraine war, which pressures their ability to negotiate higher rents. Second, high interest rates are making their debt way more expensive and compressing cap rates. Plus, their now diminished market cap makes the stock highly illiquid. And finally, they're facing fierce competition from massive institutional buyers. Think giant pension funds and even billionaires like Bill Gates, who are aggressively bidding up the price of the exact same dirt FPI wants to acquire.
Which brings us to Section 3, the fundamental paradox.
So we're basically left staring at this massive contradiction at the heart of FPI. On one side, you have the land itself, an asset with a 40-year exceptional track record, inelastic supply, and incredible inflation hedging properties. But on the other side, you have the vehicle, a company burdened by questioned governance, a token 1% dividend yield that completely fails to attract traditional REIT investors, and a subscale management structure struggling with a higher cost of capital. Actually, it's the ultimate tug-of-war between a flawless asset and a deeply flawed manager.
Because of all this, what we're currently looking at is a trapped valuation. The market is basically enforcing a severe governance discount. Even though the underlying farms are likely worth significantly more than the company's current market cap, investors are just refusing to pay full price. The consensus from the source material is super clear. As long as the founder, Paul Pittman, remains in an executive chairman role on the board, and as long as the dividend remains a symbolic 12 cents, the market will continue to heavily discount this stock. The value is just completely trapped by a lack of trust.
So I want to leave you guys with this one final provocative thought. If you're looking at this space, you aren't just betting on agriculture. You're making a highly specific bet. You really have to ask yourself, will the unparalleled, undeniable quality of American farmland ultimately force the market to reevaluate this asset? Or will the governance flaws and broken trust of its biggest public gatekeeper keep its value permanently suppressed? It's a fascinating standoff between the dirt and the boardroom, and how it resolves is going to define the future of public farmland investing. Thank you so much for joining me for this explainer, and I'll catch you next time.